Hello, my name is Dana Wiklund, Research Director for IDC Financial Insights, covering global risk management. I'd like to welcome you to our video blog, and the subject of today's video blog is an overview of current enterprise risk management issues. Institutions are really struggling now with the challenges of increased regulation. So in talking to senior risk officers, it really is a matter of, well, we need you to go right. No, we need you to wait. Well, why don't you go left, but go right now? And, truly at a fork in the road. They're dealing with mandates of immediacy. They're looking to align data and analytics to meet demand list, not wish list from regulators. And when surveyed, bankers do not feel that primary intellectual property regarding liquidity and solvency of the institution relies or sits with regulators, but moreover within expertise in the firm or with smaller firms within broader industry consultancies that have a broad view. So whether it's upgrading to a data warehouse, whether it's investing in a new asset and liability system, these investment decisions are being clouded by a very chaotic regulatory environment as we sit here today. Now, as long as there's still a perceived level of underlying systematic risk, as long as there's a democratic administration favoring increased regulation, we will continue to see stepped up regulatory pressure on financial institutions. And this is producing a lot of stress on institutions and trying to make the right decisions around data, around technology, and around methodology to deal with the increased regulatory demands. Capital budgeting continues to be a very important issue for financial institutions, and really the squeezes on the pressure will continue to build through 2010. Continued intense internal capital rationalization around projects for new business initiatives, people, projects that involve data. Companies will be looking to renegotiate their contracts and lower existing expenses. We see continued analysis and movement towards services and software solutions, cloud computing solutions that lower the cost of ownership and speed implementation so that benefits can be gained. And we also see an increased financial discipline and sophistication with evaluations on technology projects. So really capital budgeting, especially with the specter of potential additional fees being placed on the financial services industry, by the government, capital budgeting is a very large concern across many different organizations. I recently completed a survey of risk priorities through LinkedIn. And the question was, where should capital be invested this year for risk technologies? And I had a feeling that liquidity would play an issue over sort of traditional credit risk and loan defaults. And as it turned out, the concern was with liquidity. So 30% of people surveyed said that capital should be invested with liquidity and economic capital risk solutions in the next 12 months. 23% said compliance or regulatory risk. 25% what you might expect credit risk, sort of loan default tools to affect loan defaults. 12% said operational risk solutions, and then 7% said market risk solutions. So the upshot of this survey really is that there is significant attention and mind share on the part of risk professionals across the financial services industry on liquidity and asset liability sorts of solutions that involve solvency of the balance sheet, slightly more so than what you might expect in traditional credit risk and loan defaults. As we look ahead through 2010, we're probably coming through the backside of the storm where we might have felt we've been in the eye of the storm for a little while. I think what we can continue to see is risk aversions amongst financial institutions. Moving target of global regulation will continue. Continued issues around identity and access risk management. Data breaches will continue to be a concern. Traditional fraud and anti-money laundering, as well as the stress on the financial services industry. It's a real operational risk of human capital. Also, as well, issues of commercial real estate valuations, potential continued defaults in consumer real estate, and lastly, how to organize the data within the organization to better deal with risk issues. So there's quite a few issues which financial institutions will continue to deal with aggressively as we move through 2010. Thank you very much. This concludes our video blog for today. I would encourage you to take a look at our online community. You can see the URL on the screen. Many different blogs across the financial services space, discussion forums, as well as resources. And I appreciate your time today. Thanks.